Historical financial data shows stocks are likely to perform better for you than both real estate and cash. But of course, investing in stocks may seem more complex than purchasing property or keeping cash in the bank. So, investors looking for a simple way to diversify their portfolio are likely to turn to funds, ETFs, and mutual funds, the two easy ways to invest and diversify. ETFs and MFs have a lot in common, but they do have distinct features. An ETF or exchange traded fund is an investment vehicle that pools money from investors and uses the funds to buy a basket of stocks, bonds, and other securities. Investors can buy and sell shares of an ETF just like they would buy a share of a stock from a stock exchange. Mutual funds are professionally managed investment funds that trade in diversified holdings. Funds are pooled from various investors and invested with the assistance of professionals. The investment portfolio includes bonds, money market instruments, stocks, or a combination of all. The investor owns a share of the mutual fund and reaps the same benefits or losses as the other shareholders. At their core, ETFs and mutual funds are quite similar. Both are a collection of shares of many different stocks or bonds grouped together and traded as one unit. But the key difference between MFs and ETFs is the way of trading and settling. Mutual funds are traded at the net asset value or NAV, which is calculated at the end of the day, while ETFs can be traded at the current market price. Hence, ETF share prices fluctuate all day as the security is bought or sold. While one can invest in mutual funds only through an intermediary, ETFs can be purchased directly from the stock market without an intermediary. The fund manager decides how your money is going to be treated in the case of mutual funds, while the investor has to make the decision in case of ETFs. Mutual funds have a mandatory lock-in period depending on the type of fund. This period can range from 3 months to 3 years. During the lock-in period, investors cannot sell or redeem their mutual funds. However, in the case of ETFs, there is no such lock-in period. Investors can sell or redeem their ETFs at any time they want. Some MFs also levy a penalty on selling the shares before the lock-in period ends. Mutual funds have lower liquidity compared to ETFs since ETFs are not connected to the daily trading volumes. ETFs are also cheaper than mutual funds as they charge between 0.5 to 1% of the NAV as expense ratio. The minimum investment required is also higher in mutual funds when compared to ETFs. However, the transaction costs are zero when MFs are bought or sold, but an additional cost is involved in the case of ETFs. ETFs, however, are more tax efficient than MFs as they realize fewer capital gains when compared to mutual funds.